Guys, I think we're live, which is good. I am going to be talking about timelines. So I discussed this last night. I did a video where I talked a little bit about the reasons why it is that traders can have a essentially a short-term perspective, and down to the fact that naturally they are going to be in a position where they are getting results potentially quickly. They might be in and out of trades in a day, in and out of trades in a very short period of time, sometimes in a matter of hours. We're also very used to getting what we want very quickly these days. So we're in a culture where that longer term view is a bit less valued, is the way that I see it. So what can you do as a trader to make sure that you have a long-term consideration? And also, what I'm going to talk about is a few specifics that will help you do this. So, one of the things to think about, and the first important thing to think about, is when you're trading, that essentially you are making shorter term decisions. If we think about a trader as somebody that's going to be in and out of the market at a push over a 3 month period, possibly they might hold a trade slightly longer, up to 6 months. So the trader is looking at no more than 6 months. The investor, as an absolute minimum, would be 6 months. So that's essentially where the line is. So what I want to do first is draw a couple of conclusions that I think will really help. So when you're trading, essentially you're working with three elements. Okay, so cash is your big friend because you're leveraging your cash. As you trade, then you want to look at focusing on that alongside investments. And what I call this is the intersection between trading, cash, and investing. So what is it about investing that will benefit a trader? Okay, is it the process of picking trades that will essentially benefit you as a trader? In my belief, it's not. What it is about investing that you want to be focused on, and why investing can help you, is the long-term perspective or the long-term mindset that a successful investor will have. From an investment point of view, our outlook should be about 5 to 10 years as a minimum, and good investors and consistent investors will be looking way out of that. Now, that doesn't mean they don't consider the results that are happening prior to that, but there is an element of consideration for the long term. The challenge is the trader is usually looking over a 1 to 2 month period. So what I would suggest with you as a trader is you want to be looking over this period here. So use the investing mindset with your trading. And as I said last night, it's okay to be in cash. So from the cash perspective, the intersection between the two, it's okay to be in cash. A lot of traders feel like they must be in the market all the time. They must have positions out in the market, but it's actually more than okay to be in cash. Okay, so bear that in mind. It might feel like you might have a week, especially as a swing trader, or you might have 2 weeks as a swing trader where you haven't had a lot of trades. You might have had one trade or barely any, and it feels as though you're wasting time. But if you relate that to the longer term perspective, a couple of weeks in cash because there isn't an appropriate setup there is actually going to be beneficial for you than taking trades and wasting the cash you have on positions that don't serve you, that didn't meet your criteria and end up costing you money. And then the last element is the trading element, is the ability to still appreciate and respect the short-term element of what you're doing. Sometimes traders will try and hold trades for too long. It won't be part of their process, and they adopt this long-term idea and try and run trades for a long period of time, and then the trade comes back on them and they end up missing out on a 3 or a 4% return that could compound their account, and then when they go again on the next trade, be in a position to make another 3 or 4% or a 2 or 3% on that trade that it's compounded. So the other thing is it's that balance. Trading is the shorter term pursuit. So essentially, as I'm saying, it's the intersection between these three elements. You're looking for the point where you can work these in an optimum way. So the first thing you've got to do is say, okay, if I'm going to trade a strategy, there are going to be periods of time in cash. But as I said last night, one of the things that is really important with this is going, well, okay, if I'm going to be in this trade for a long period of time, or this strategy for a long period of time, if today is my starting point, that this is now, okay, I don't know what the results are going to be going forward. The only thing that I can do is use data from the past. And this is something that I think is really important and missed on, is what I will do is I will cross-reference, or I will look at an appropriate period of time for data, and I will cross-reference that against the trade frequency of the strategy. Now, I mentioned this last night, but this is really important because if you are trading something that is trading, let's say, 10 trades a week, So it's a day trading strategy that's giving you 10 trades a week. One of the things that's really important to understand is that at 10 trades a week, you will be able to get 200 trades in terms of a data sample. You'll be able to get that by going back essentially 20 weeks. Now, it might be that you want to go a little bit further than 20 weeks. You might go further than 6 months. Might want to go back a year. But once you've got a year's worth of data on a trade frequency and a day trading strategy that's hitting 10 a week, or even some cases um, hitting 20 trades a week, then you can go forward. Yes, you still want to maintain a long-term view with that strategy. You probably want to look at least a year into the future. But what you can do is every quarter you can cross-reference your quarter's performance against any one of the 4 quarters from the previous year's worth of testing. Once you've traded another quarter, you can compare this quarter against this quarter. You can compare this quarter against any of the other quarters, and you can compare this 6 months against the last 6 months, the first 6 months, or the middle 6 months. So what you're doing in that scenario is cross-referencing the performance, but you are still thinking, if we take the quarters there, I've drawn it a bit badly, but if we take each quarter, what we can do is cross-reference the performance relative to the data that I've got. And what that does is that helps give me perspective. And also, if quarter two hasn't been great, then it might be that quarter three last year wasn't great or quarter one wasn't great. So again, that gives you some perspective. It makes you think less about suddenly making changes in what you're doing in quarter two. And this is why data, well, this is one of the list of reasons why data is so important to us at TSC and so important and such an important part of what we do. So there's an example. If we were talking about it from a swing perspective, then for me personally, if I'm trading a swing strategy and I'm starting that now, it's exactly the same principle, but rather than a year, what I'm going to want is I'm going to want 5 years worth of data over the relevant markets that I want to include in that strategy. And it's exactly the same process. The difference is I will probably check in a quarter, but won't really make too much of an effort for 6 months, or even in relative terms, and again, I've drawn it bad, if we put 6 there, relative terms, a year. So what I'm going to do is say, well, once I've got a year's worth of live data trading that strategy, I can compare it to year 5, year 4, year 3, year 2, year 1, and I can see whether or not that year is underperforming, overperforming, whether it's about average, whether it's relative to one of those years, or my performance that year, let's say overall it was 50% return, that actually is in line. So my yearly performance is in line with the 5-year average, or my yearly performance is in line with the last 2 years of that performance. So what it does, again, it gives me the perspective rather than was it my best performing year? Did I do better than last year? I see this with a lot of traders. It's natural to want to do better than the previous year, and there's nothing wrong with aiming for that, but it doesn't necessarily mean you've failed because you don't reach that point, because the market simply might have been offering you a lower performing year in comparison to the data that you have previously. So how can we relate this to where actual scenarios, actual trading plans? So what I'll do is I'll go through a little bit or an overview of what I do. So essentially, I do position trading. So I have a position trading strategy and I have a swing trading strategy. So if we think about the position trading strategy, the average return for this is 18% per year. So that's the average return. Now this is important. That is over a 20-year period. So for me, with this strategy, what I'm going to do is before I start trading it, I'm going to want 20 years worth of data, which is what we've got. Now, why would I want 20 years? Well, remember, it's to do with the trade frequency. This strategy only sets up once a month. This is our beat the bank strategy. Sets up once a month. You only trade it once a month, and it is a maximum of 24 trades in 1 year. It will probably be somewhere between 12 and 24 trades, but it's an absolute maximum of 24. So from a trade frequency point of view, I'm only going to get 24 trades in as a maximum that year. So in terms of data, yes, that gives me 1 year's worth of data, but with such a low trade frequency, what I want to do is get more years worth of data, so my overall data sample is bigger. Now for me, I won't look at this over a 3-month period, a 6-month period. I will review the data at the end of the year. I obviously know the result month by month, but I'll look a year down the line, not 20 years down the line. I'll look a year down the line, but in the same breath, I won't look 2 months or 3 months down the line. But in terms of any significant changes, I won't make any significant changes to that strategy until I'm at least at 3 years, probably 5, which means if I have a bad year or maybe even 2 bad years on this, then I'm going to soak those up because I'm going to look at it relative to the previous periods within that 20-year period. So let's say I have a bad year. Now, this year, or the year just gone, so 2020, it was up about 30, I think it was about 37%. Now, if I look back, that was one of the better years. 2018 was down -1%. And again, I can cross-reference either the good years or the bad years and relate them to the best performing years. I can relate them to the average. I can take the average of 218, 219, and 220, work the average out of that, look at that against the overall average, or look at it against any 3-year period. So this is the level of work we'll do to look and get a perspective and get a long-term process on that. So for me, this strategy, I've got 20 years worth of data, but I've actually got a 15-year plan on this strategy. So there is no intention for me to stop trading this or really do anything different. There might be the odd tweak for 15 years. So what happens is I tick along with that strategy, I tick along, I tick along, I tick along. And if that strategy gives me the average I want, then that alongside my swing trading strategy will get me to where I want to be, not in 15 years, but in fact in 10 years. So with my swing trading strategy, what I'm looking for is I'm looking for a greater return. The average return of my live performance over the last 6 years is 50%. In fact, it's just slightly over, it's 52%. So what I'm looking for as an average, it doesn't necessarily mean if I don't hit 52% that year, it's been a bad year. For example, last year I only hit 38%, but the year before was 70, 75, I think it was nearly 76%. So if you look at it overall, over the last 2 years, okay, I'm slightly above my average. But what I'm not doing is necessarily saying that I shouldn't be trading or berating myself because I hit the 38% in 2020. But what I will do is I'll look to optimize, I'll look to do better. So the plan for me with this particular strategy, the outlook for this is slightly less. The outlook for this is 5 years. So the plan with that is to compound the swing trading account over a 5-year period. And then what I do on top of adding money in on the position trading strategy, what I'm looking at is I'm looking at a 15-year period. So at the end of that 5-year period, I can compound and move funds into that account and then run that for another 5 and run that for another 5. So it's not that I'll stop trading the swing trading account in 5 years, but that's the view in terms of returns, so I can extract a certain amount of money and move it across into the lower trade frequency, slightly lower risk position-based account. So this is a process of using that perspective and using timelines and knowing the results over a period of time to aid you as a trader. Good. I hope that was useful. As I've said, if you want to learn more and you're not a member of TSC, head to tradersupportclub.com, click on any of the blue Start Right Now buttons, fill in the modal, and you'll get access to free workshops. We've got 2 free workshops coming up in February. It's where you can get my book, my audio book, Lessons from a Trading Room, completely free. We have got links there to other trainings. You can access our private members Facebook group, and I'll see you again. I'll make sure I'm back, I think Monday. Yeah, it'll be Monday with a market review.